Hey guys, Jason Herring here with Insurance and Estates, serving as your IUL specialist. So today, let's spend a little bit of time talking about the different indexed accounts that are inside an IUL policy. Get a lot of questions, a lot of people when you schedule time on my calendar. A lot of the questions that we deal with is how do these index accounts work? Why are there 10, 12, sometimes maybe different index accounts to choose from? And how do we make some decisions around which accounts to use so that we can maximize the ability to grow our cash value? So really thought that the best way to explain that would be just to pull up an example of one of the carriers that we use, and we can kind of walk through the different kind of moving parts inside these index accounts and kind of tell you when you might want to use them, when you might want to use one of the other accounts, and give you some kind of input a little bit on my thought process as I'm working with our clients. So you'll notice here with Nationwide, one of the IULs that I've really started using a little bit more of here lately and really like, you will see that there are several different strategies available. And most carriers will break down their strategies into two different buckets. Nationwide basically calls these top strategies here the traditional options for you. And then every IUL today is having some type of volatility control strategy. These strategies are usually there to help manage volatile markets when the S&P 500 might be up or down. Maybe the S&P is down for a long period of time. These volatility control strategies are built to really come in and help you get some type of rate of return on your cash value while we wait for some of the traditional strategies to come back to us. But as you go through, all of these strategies will have three main areas of attention that you need to place with them. The first being the cap rate, second being the participation rate, and then third being the floor rate. So I think most people understand that IULs, you're able to participate in the upside of certain indexes while being able to enjoy not having to participate in the downside. And as you can see here with Nationwide, the floor is 0 on all of these accounts. So if you pull out here the S&P 500, and let's say that in 1 year period of time, the S&P is down 12%, then you simply get credited 0. You don't have to participate in that down year. But on the flip side, if the S&P has done very well, and let's say it's up 15%, then Nationwide is going to credit your cash value at 10.25% rate of return. So the beauty of an IUL is you don't have to participate in the down years, but you get to also participate with limited crediting based off of the good years. And I would say a 10.25% current cap is pretty industry standard. There's some caps that are a little bit higher on the S&P 500, but this is a good account. Now, what you'll see underneath, and you have to make sure that you pay close attention to the fine print sometimes, is that Nationwide does have the ability to lower that cap down to 4%. So if the markets became extremely volatile and option pricing became very volatile and they were having a tough time managing the option pricing, then they could actually lower that cap all the way down to 4%. Now, guys, I've been doing this for 16 years now. Even when interest rates were extremely bottomed out, even during COVID when we had a lot of volatility in option pricing for the S&P 500, I've never really seen rates much lower, cap rates much lower than 7, maybe even 8%. So the chances of dropping to a 4% guaranteed cap are pretty low. Can't say that it's not going to happen, but that's not really how these products are designed to ever have to get there. So if we have clients that are a little bit more conservative and they just want to go after maybe a 6, 7% average rate of return, then we'll use the S&P 500 for a lot of their crediting. You can see here that with these traditional strategies, the participation rate is guaranteed at 100%. So that's nice to see that whatever these indexes actually, how they perform within that 12-month period, you will always enjoy 100% of that crediting up to the cap. Now you'll see right here in the middle, they have an S&P 500 uncapped account. Sounds like a pretty good deal, right? You know, if the S&P produces 25% crediting, I'll get 25% crediting. But what you have to watch for is that most companies will have some type of a spread attached to their uncapped S&P 500. So in this scenario here, Nationwide is currently charging a 6% spread with a 10% number guaranteed. What that simply means is if this account were to return a 26% rate of return in 1 year, Nationwide is going to keep the first 6% and credit your account at 20%. Sounds pretty good for fixed money, right? It sounds pretty good for fixed money and not having to participate in the downside. But think about it from this type of crediting strategy as well. Let's say that the S&P 500 returns a 6% return over that 12-month period, and we know that Nationwide is going to keep the first 6%. Now you get credited 0, where it may have been more advantageous for you to be in the traditional S&P 500 account with the cap rate because you would have gotten that full 6% crediting. So just some things to think about as we look at these traditional strategies. Now, where every IUL carrier right now is trying to build the next greatest IUL is all in these volatility controlled strategies. And you can see all of these accounts are uncapped. All of these accounts have massive participation rates, right? 185, 235, 210, 265, all the way down to 315%. So what does that mean? That means that if this BNPP Global Factor account returned a 10% rate of return over your 12-month period, you would actually be credited 315% of 10%. So these accounts are extremely attractive and they look very good on paper, but there's a couple things you need to remember about these accounts. First off is that most of these accounts are very new and we don't have a lot of historical data on these accounts. So we don't know, it's hard to get an idea of exactly what these accounts might return. Also, you have to look at the fine print and see that most of these accounts have a 65% guaranteed participation rate. So what does that mean? As these accounts become more volatile and option pricing gets a little bit more volatile with these accounts, the companies can lower the participation rates all the way down to these guaranteed rates. And over my 16-year career now, I've seen that happen. There's some companies out there that started with some really nice participation rates and they're down around their guaranteed current par rate. So, you know, I don't have a problem with clients using some of these and especially using these accounts very strategically when we're having a lot of volatility with the traditional strategies. But for most of our clients that are coming to us that are just trying to overfund an IUL, that are trying to grow as much cash value as possible to use that cash value for tax-free retirement income, that's what most of our clients are doing. I really do like to focus on the traditional strategies, and we might mix in, maybe put 20, 30% of your cash value in some of the volatility controlled strategies just to take some of these higher participation rates out for a ride to see what we can do with these. So guys, I really hope that this video today helped you understand a little bit more about the indexed accounts and your different options that you have available inside of these index universal life contracts. It is so vital that you work with an agent that's been doing this for a while, that understands these accounts, that has seen the ups and the down of these high participation rate accounts, and can really help to caution you and help guide you as we look to figure out which carrier is going to be the best IUL for you and what your goals are. 16 years of experience has really taught me exactly what I need to know to help you grow cash value. So guys, if you would like to learn more about Index Universal Life, if you would like to schedule a meeting with me, feel free to reach out to me by email, jason at insurance and spell out and estates.com, Jason at InsuranceandEstates.com. I'll be happy to schedule some time with you, build you a couple of different illustrations, help you understand better your strategies, and really get you all set to enjoy a life insurance policy that is overfunded to maximize cash value and really give you a nice path to some tax-free retirement income one day. Guys, I hope you enjoyed this video. Be on the lookout for several more, and have a great week. Take care.